7 investing myths that are holding you back. Ever felt like there's a mysterious force holding you back from diving into the world of investing? Well, get ready to reveal the 7 secret saboteurs that might be stealthily sabotaging your financial journey. Forget what you thought you knew, because we're about to bust the myths wide open. It's time to rewrite your investment story, and trust me, you won't want to miss a minute of this myth-busting extravaganza. Myth 7. You need to be intelligent to invest. People often think of investing as something only really smart folks, especially those into finance, can do. This idea suggests that you need a super sharp mind and a deep understanding of tricky financial stuff to be an investor. But guess what? That's not true at all. Investing is basically about putting your money into things and expecting to make more money over time. Even though professional investors use fancy strategies and complex financial tools, the main ideas of investing are something anyone can get if they're ready to learn and stick to a plan. The idea that investing requires super smarts comes from the mistaken belief that you need to predict how the market will move and make quick decisions based on complicated financial models. But really, successful investing doesn't usually involve those fancy tactics. It's more about knowing some basic money concepts, having good strategies, and thinking long-term. Understanding basic money concepts like risk and return, the power of compounding, and why it's good to spread your investments around diversification is key. Even without knowing super advanced money theories, these concepts help you make smart investment choices. Good investment strategies, often called passive investing, mean putting your money in low-cost funds that follow big market indices, like the S&P 500. This way you don't have to stress about picking individual stocks or timing the market, reducing the chance of making quick decisions based on feelings or short-term market changes. Thinking long-term is also very important for successful investing. The stock market goes up and down a lot, but looking at history, it generally goes up over the long run. By having a long-term plan, you can handle the times when the market isn't doing so well and benefit from your investments growing over time. Plus, thanks to the internet, there are tons of online resources and advisors to help you learn about investing. Now, anyone can get educated about investing principles, check out different investment options, and even get advice from professionals to create a plan that fits their money goals and how much risk they're comfortable with. So in the end, the idea that you need to be super smart to invest is just a myth that's kept many people from taking charge of their financial future. Investing isn't about predicting the market or being a financial genius, but some basic money know-how, good strategies, and a focus on the long term, anyone can become a successful investor and reach their money goals. Myth 6. Percentage gain equals percentage loss. In the world of investing, people sometimes think that gaining and losing percentages are the same. They might believe that a 10% gain is just like a 10% loss. However, this idea doesn't consider how the stock market really works and what causes it to go up and down. Unlike a game where one person's win equals another person's loss, the stock market is more complicated. It's influenced by many things like economic growth, technology, and how companies innovate. These factors, along with how investors feel and the balance of supply and demand, make the market move in unexpected ways. Let's look at an example to show why thinking gains and losses are the same as wrong. Imagine you buy a stock for $100 per share. If the stock goes up by 10%, reaching $110 per share, you gain $10 for each share you own. On the other hand, if the stock goes down by 10%, dropping to $90 per share, you lose $10 for each share. Even though the percentage change is the same, 10%, the actual money impact is different. A 10% gain means you earn money, but a 10% loss means you lose money. This shows it's crucial to consider how much you initially invested when you talk about gains and losses. Thinking that gains and losses are equal also forgets about the power of compounding returns. Compounding is when you make money on the money you already earned. It's a big deal in the stock market. Over time, even small percentage gains can add up to a lot because of compounding. Diversification is another important idea. It helps lessen the impact when the market goes up and down. By spreading investments across different things like sectors, industries, and regions, you can reduce the risk of losing a lot in one area and benefit from overall market growth. In summary, the idea that gaining and losing percentages are the same doesn't capture how the stock market really works. Investors need to realize that percentage changes show relative gains or losses, not absolute values. Also, Diversification and compounding returns are key to achieving long-term financial success. By understanding these ideas and having a good investment plan, people can handle the uncertainties of the market and work toward their financial goals. But hey, before we continue, we want you to know that we're always making new content, so make sure you like and subscribe to our channel so you don't miss anything. Myth 5. The stock market has an obligation. The idea that the stock market must guarantee profits for investors is a common misunderstanding that can cause unrealistic expectations and financial problems. It's important to know that the stock market isn't a sure thing. It's a dynamic place where companies raise money and investors aim for growth. The main purpose of the stock market is to let companies get funding for growth while giving investors a chance to join in their success. However, getting involved doesn't guarantee making money. The market is always changing, affected by things like the economy, industry trends, and how individual companies are doing. People often start investing thinking they'll always make a profit, seeing the stock market as a guaranteed way to earn money. This mindset can lead to quick decisions and ignoring the risks even though the market has had times of growth. It also had downturns. The stock market isn't obligated to give returns. It works based on supply and demand, where share prices change depending on what people think they're worth and what buyers and sellers do. Investors decide when to get in, taking responsibility for their choices and the risks involved. While the stock market can help build wealth, it's important to approach it with realistic expectations and a good understanding of the risks. Don't see it as something that must give you money. See it as a place for making smart choices and working toward long-term financial goals. Myth 4. Buying because the price has fallen. Many people mistakenly believe that when a stock's price goes down, it's automatically a good time to buy. However, this idea ignores the reasons behind the price drop. While market changes can cause prices to fall, they often indicate problems within the company or the industry it's in. Before deciding to invest in a dropping stock, it's important to do thorough research. This means looking at the company's financial statements, studying its management team, and understanding its competition. Knowing why the price is falling helps investors make smart choices. Just thinking a lower stock price means it's a good deal is risky. Investing in a company with problems could make the price fall even more, leading to big losses. Instead of blindly going for cheap stocks, investors should carefully think about the company's future and make decisions based on good financial sense. Myth 3. More stocks mean more diversification. Many people believe that having lots of stocks makes their investments safe, but this idea is not entirely correct. While it's essential to diversify your investments, simply owning many stocks is not enough. Real diversification means spreading your money across various types of assets, like stocks, bonds, real estate, and commodities. It's not just about having a large number of stocks. If, for example, most of your stocks are in the technology industry, even if you own many of them, it doesn't really protect you from risks. The tech industry can be unpredictable, and if it goes through a tough time, your entire investment might suffer. To diversify well, you need to go beyond stocks, invest in different types of assets, and spread your money across various industries and regions. This way, if one sector or region faces issues, it won't hurt your whole investment. Diversification helps manage risks and makes your investments more stable even when the market goes up and down. So remember, true diversification is not just about having more stocks, it's about smartly spreading your money across different types of assets, industries, and regions to create a well-balanced and safer investment. Myth 2. You lose money when the market crashes. The stock market can be a bit tricky. Some people think that when it goes down a lot, you'll lose a ton of money, but that's not the whole story. Yes, the market has ups and downs, like when it suddenly drops, it can be scary, and you might lose money for a bit, but here's the thing, it always bounces back. Think about it like this. The market has been through tough times before, where it went down but then it picked itself up and grew again. These tough times, even though they make you lose some money at first, don't stop the market from growing in the long run. So if you're planning to invest for a long time, the key is not to panic when the market acts up. Stick to your plan, don't make quick decisions based on short-term changes, and think about the big picture. In the end, staying calm and focusing on the long-term gains can help you make the most out of your investments. Hey there, before we reveal the top one on the list, make sure you tap that subscribe button and turn on the notification bell. This way, you won't miss out on our newest videos. You can decide if you want notifications for just a few videos or all of them. It's your choice, and if you're using your phone, don't forget to enable notifications in your settings. Myth 1. Buy at rock bottom. The idea of finding the absolute lowest point when a stock's price is at its cheapest, often called buying at rock bottom, might sound tempting to many investors. The thought of getting a stock at the lowest price and expecting it to go up later seems like a way to make a lot of money. However, trying to catch the exact moment when a stock is at its lowest can be a tricky and often unsuccessful effort. The unpredictable nature of market movements, influenced by various factors like the economy, global events, and how investors feel, makes it hard to predict when a stock will hit its lowest point. Instead of obsessing over trying to find this elusive rock bottom, a smarter approach for investors is to follow a disciplined strategy. This means buying good quality stocks at reasonable prices. This strategy involves looking at a company's basics like its financial health, growth potential, and competitive advantages to figure out its real value. By focusing on what a company is truly worth instead of always trying to get the lowest market price, investors can make smart decisions that match their long-term investment plans. Even though market ups and downs are bound to happen and stock prices will go through tough times, giving it to the idea of always buying at rock bottom can result in missed chances and possible losses. A more logical approach, concentrating on buying good stocks at fair prices and sticking to a long-term investment plan, is more likely to bring positive financial results. So there you have it, the 7 investing myths that might have been holding you back. Now, which myth surprised you the most? Did you think you needed a PhD in finance to start investing, or maybe you believe buying at rock bottom was the ultimate strategy? Drop your thoughts in the comments below. And as always, don't forget to hit that like button if you found this video helpful, and subscribe to our channel so you never miss out on my latest content. And for more resources and links related to today's topics, be sure to check out the description below. Thank you for watching, and we'll look forward to reading your comments and engaging with you in the next video.